Welcome to The Explainer, where we break down big topics into simple, actionable guides. Today, we are tackling one of the most important financial steps you can take. We're building your playbook for getting started with investing. So you're all set to get going. But then, this question pops up. And let's be honest, it's the one that paralyzes so many of us, right? We get caught up trying to find that one perfect, magical moment to jump in.
Well, here's the real answer. It's not about timing the market. It's about time in the market. Seriously, the most powerful thing you can do is just begin right now.
Okay, let's dive into the playbook. We've broken this whole thing down into 4 really simple sections. This is going to take you from just thinking about investing to actually doing it step by step. First up, Section 1, the investor's mindset. Look, before you put a single penny to work, getting your head in the right place is the absolute foundation for everything else. This right here is a huge mental shift. You've got to stop thinking of stocks as just little blinking symbols on a screen. Instead, think of yourself as a part owner of a real business. Start asking yourself, do I actually get what this company does? Do I believe in it? And this is where you realize you probably have an advantage you never even thought about. Your own life, your job, your hobbies, gives you insights that Wall Street analysts just don't have. We call this your unique selling proposition, or USP. Maybe you work in logistics and you suddenly see one company's trucks everywhere. That's your edge.
All right, with that mindset locked in, you are ready for Section 2, making your first move. This is where we turn all that thinking into real action.
The game plan for starting out is actually super clear. 1, start simple. Don't try to get all fancy. 2, start small. Don't throw all your cash in at once. And 3, start regularly. Set up a cadence. This discipline is what takes the emotion out of it and builds wealth over time. Now, starting simple usually means looking at something called an ETF, or an exchange-traded fund. Just think of it like a shopping basket that already holds stocks from a ton of different companies. So with one single purchase, you're instantly diversified and it costs very little. It is a fantastic way to get comfortable with how the market moves. Okay, on to Section 3, how to research companies. Now, don't let this part intimidate you. You're not trying to be an accountant here. Think of yourself more like a detective, just looking for some basic clues about a company's financial health. And the first rule of any good detective work is to make a fair comparison. You gotta compare apples to apples, right? That means you should only really judge a company against its direct competitors, the other players in its exact same industry. That's how you get a real sense of how it's doing. Next, you need to follow the money. At the very top, you have what's called the top line, or revenue. That's all the money a company brings in from sales. But then, after you subtract all the costs and expenses, what's left over at the bottom is the bottom line, or net income. You have to check both, because a company with huge sales isn't always a profitable one. This slide gives you 2 really simple tools for a quick valuation check. For a big, established company that's already making a profit, you can use the price-to-earnings, or PE ratio. It helps you see if the stock is cheap compared to its profits. But for a younger, high-growth company that isn't profitable yet, the price-to-sales, or PS ratio, gives you a much better picture. So while all that stuff tells you about a company's performance, the balance sheet tells you about its survival. This is the crucial health check. You're basically asking, does this company have the financial strength to get through a storm? And a key number for survival is the debt-to-equity ratio. It just shows you how much the company is relying on borrowed money versus its own funds. A really high level of debt can be a major red flag, especially if the economy hits a rough patch or interest rates go up. And you can find all this stuff, by the way. It's in your broker's research tools, or you can listen to a company's quarterly earnings calls. Sure, social media can be a good place to get ideas, but you have to remember the most important rule of all. Treat it as a starting point and always do your own research. And that brings us to our final section, Section 4, managing your investments. Because, buying a stock is really just the beginning. The real key to success is what you do next over the long haul. So here's the deal. You have to have a clear reason, a thesis, for why you bought into a company in the first place. If that fundamental reason changes, if it's no longer true, then it's time to sell. Do not fall into that trap of just hoping you'll get your money back, because that day might never come. This brings you to a core decision every investor has to make. Is the stock's price down because the company itself is in real trouble? Well, that's a reason to consider selling. Or is it down just because the whole market is having a bad day, while your original reason for owning it is still totally valid? That could be a buying opportunity.
And that's where a strategy called dollar cost averaging, or DCA, is so powerful. By investing the same amount of money on a regular schedule, you automatically end up buying more shares when prices are low and fewer shares when they're high. It's a disciplined way to build your position in companies you really believe in for the long term. And finally, always try to be tax efficient. Different countries have different options. For instance, in the UK, a couple can invest up to £40,000 a year into a stocks and shares ISA and pay zero tax on the gains. Using accounts like these, wherever you live, is one of the biggest boosts you can possibly give to your long-term returns.
So let's wrap all this up. The key takeaways from our playbook are pretty simple. 1, start now and start simple, maybe with ETFs. 2, think like you're a business owner. 3, learn to do a basic financial health check on companies. And 4, know your reasons for selling and know when it might make sense to buy more. We've laid out the entire strategy for you, from mindset all the way through to management. This is your playbook. Now, it's your move. And we'll leave you with a final thought to get you started. Just forget all the noise for a second and think about what you uniquely know. What is the one business you understand so well that you'd actually be proud to own a piece of it? Answering that question might just be the best first step you can possibly take.